It's impossible not to see all of the news reports, the news articles, the content that's being created right now talking about the pending economic collapse, not only in the United States, but worldwide. But what nobody's talking about is why it is that the rich, the wealthiest people, not only in the United States, but around the world, are actually looking forward to the upcoming collapse. I came from a very poor family. I'm a first-generation American citizen. I grew up in rural Pennsylvania. My parents were crushed by the economic bubble bursts during the dot-com era, during the housing bubble crisis. They have seen their life savings dwindle and then try to slowly grow back multiple times. So it wasn't until I became the first person in my family to achieve any significant wealth that I learned the trick that the rich are using, not only to prepare for the upcoming collapse, but to actually win because of it. And that's what I'm here to share with you today. I want to show you how the rich are preparing to win during the upcoming collapse and why it is that they're looking forward to a global economic crisis. There's a fundamental difference between how wealthy people and not wealthy people see money. People who are not wealthy tend to see money as something that they have to earn in exchange for their time. So they work hours and they earn an hourly wage. They work for a year and they earn an annual salary. So there's a very natural sense that you have to work in order to earn. That's how people without wealth think, because that's how all of us have been conditioned since we were little. Even when we were kids, we had to work chores to earn money. And then we had to work part-time jobs to earn money. And then we had to work full-time jobs to get money. And we had to work our way through college to get money to pay for college. You've done this your whole life. You already know it's a fundamental truth. The problem is it's not actually a truth. It's just what you've been conditioned to believe. Wealthy people understand that money can be made in a lot of different ways. Yes, you can trade your time in exchange for a paycheck, but you can also trade your money in exchange for money, something they call investment. You can also use innovation and ingenuity to create patents that protect your IP, and then you can use your IP as money. There are wealthy people out there who rent their properties for money. There are people who rent their ideas for money. There are people who even rent their name in exchange for money. Our president in the United States makes a fortune simply by putting his name on real estate. So because wealthy people and not wealthy people fundamentally see money in two different ways, they of course see economic pressure in two different ways. And that's because as the economy starts to feel pressure, as the economy starts to shrink, as the economy starts to feel the pressure of fiscal changes, as inflation rates go up or go down, as lending increases or decreases, it makes it very difficult for the average person just to make it through day-to-day life. You have felt this yourself. As interest rates increase, it's a net negative for you because it makes it harder to get a loan. It makes it more expensive to get a loan to get a car. It makes it more expensive to get a mortgage. It makes it so that your dollar actually goes less far because you can't afford to take loans because loans are so expensive. You probably don't even qualify for a lot of the loans that are out there. And when you do qualify, they make up for your uncertain credit history by increasing the rate at which they lend you the money. When I was about 22 years old, I took a loan coming out of college. And I remember being excited that I had enough credit history to take a loan. I looked right past the fact that my loan had a 19% interest on it. And because of that 19% interest, I was actually never able to pay that loan off. I actually had to go into a debt consolidation effort when I was in my early 30s in order to find a way to actually pay more than I owed into the loan. You may know what that feels like yourself. So the everyday person has a hard time keeping up with a changing, shrinking, pressure-filled economy. But a wealthy person has the opposite effect. You see, banks want people to take loans. So they use the interest rate as a way to incentivize certain people to take loans. They don't want the everyday person to take a loan. They want the wealthy people to take loans. So even while you were seeing high interest rates for your car and for your mortgage, wealthy people had much lower interest rates that were being offered to them than what was being offered to you, because the banks saw people with established wealth, people with large savings account, people with significant assets, people that had multiple mortgages. They saw those individuals as less risky. than the average person. So while you might have been offered a car loan at 8%, they were being offered a car loan at 4% or 5%. So the change in interest rate and the change in borrowing behavior between wealthy and non-wealthy is already immediately evident, because while you were being discouraged and dissuaded from taking loans, the wealthy were taking loans. And that's why even as we've watched interest rates stay high and housing costs increase, there's still a shortage of supply because people keep buying homes. People keep buying cars. There's a national shortage right now of new vehicles, even though the average cost of a new vehicle has gone up to $50,000. Think about that. The average new car costs $50,000. I remember when a new car cost $18,000, and I'm not that old. This is one of the key reasons why the rich get richer in a time of economic pressure or economic strain, because the average person is forced out of the market, while the wealthy person is able to not only stay inside the market, but they're able to go further with the money they have. They can buy more houses, they can buy more cars, they can invest more into the stock market, they can take on more debt because banks want to lend to them when they don't want to lend to you. A second reason why wealthy people are very comfortable in a shrinking economy is because they know that they have the ability to make money almost at will. They can lend their money, they can invest their money, they can use businesses as a way to leverage money or increase money. So they have a way of turning their ideas and thoughts into actual currency because they can change a product. This is one of the key reasons why even in our shrinking economy for the last 5 years, you have seen new innovations in AI, new technology, new models being released by some of the biggest brands out there, from Microsoft to Apple. You've seen new concerts, you've seen new events, you've seen new live experiences, you've seen new innovations in travel, because wealthy people understand that in a shrinking economy, they can innovate, they can turn their ideas into something that the average person will then purchase. And because the average person who can't take loans is spending their real money on new innovations, all that money is coming into large established businesses. And then those large established businesses, being run by very wealthy people, can use that money and leverage it to get better bank loans and to increase their business holdings, not only by buying property, but sometimes by actually buying other businesses themselves. From just these two lenses, you can see how different life is for the average person. And I don't mean like the average poverty-stricken person, I mean the average middle-class person. You can see how different their experience is as typical middle class against somebody who's even on the lower end of wealth, somebody who's only worth a few $1 million, $2 million, $3 million net worth. There's a massive difference in how the world sees them and how they react to economic crisis. Now that you understand the difference between how the two think, let's talk about what the wealthy are doing right now to prepare to win during the upcoming economic collapse. I already told you that I grew up in a poor household. I knew very well what it was like to be lower middle class, to be middle class, to be upper middle class, to watch my parents work their entire life, to see how their savings accounts, how their 401ks, how their retirements completely changed based off the shifting winds of the economy in the 1980s and the 1990s. I watched that happen, and as I became an adult, I wanted nothing more than to never have the experiences that I watched them have when I was a kid. I actually thought that bankruptcy would be better than this constant grind to just barely make it by. And that experience has shaped my whole life view, not only on the world, not only on international politics and economy, but that's why I joined CIA, because I wanted to be outside of that grind. I wanted to be outside of that bubble that so many of us find ourselves trapped in, beyond the reach of politicians and beyond the reach of simple economic pressures that were being controlled by people who I didn't even vote for into office. I wanted to find a way to protect myself and protect my family from those changes. And as a result of my decisions, yes, I found my way into CIA, but more importantly, after I left CIA, I found my way into entrepreneurial business. I found my way into growing a business. And that business has taken me into communities of very wealthy people. There's essentially three types of wealth. There's what we would call average wealth. Average wealth is people who actually have a net worth of about $5 million or less. What is net worth? Net worth is the sum total of the entire value of that person's existence. So yes, that means bank accounts. Yes, that means checking accounts and savings accounts. But it also means the business that they own. It also means the intellectual property that they have. It also means the outstanding properties or real estate assets and market investments that they also have. Believe it or not, many people after the age of 60 start to get into the place where they have a net worth of $1 million to $2 million. It takes an entire life to build the kind of investment foundation that brings you up to $1 or $2 million net worth. And that does classify you as average wealth, which is different than upper middle class, or lower middle class. The second category of wealth is something called high net worth. People of a high net worth have between $5 million net worth and about $50 million net worth. There are thousands of Americans, tens of thousands of people who have a high net worth, a net worth of between $5 million and $50 million. Again, sum totaling all of their bank accounts, all of their cash, but also their investments, their properties, their business, their IP, their reputation, etc. And then the third category is ultra high net worth, what's called UNHW. Ultra high net worth are people who have a net worth in excess of $50 million. We've all heard about the people who have net worths in excess of $1 billion, but there are thousands upon thousands of people who have net worth in the hundreds of millions of dollars, $300 million, $600 million. It's insane how much wealth there is in the United States, but also how much wealth there is around the world. And these ultra high net worth individuals are in a completely different category of wealth than high net worth and average wealth. Regardless of the three categories of wealth, however, the behavior across all three of them is essentially the same. And that's why they're all preparing for the upcoming economic collapse the same way. It's why they're all looking forward to the upcoming economic collapse, because they realize that their wealth gives them an opportunity that you and other average citizens just don't have. The first opportunity that the wealthy have that makes them look forward to the upcoming economic collapse is something called diversification. They have the ability to diversify their money into multiple different asset classes that are actually going to be insulated against the oncoming economic collapse. A big part of understanding this idea of asset diversification comes from understanding what actually happens during an economic collapse. When governments are in trouble, they start to mess with their economy to try to save their political troubles. This is what we're seeing in the United States right now, what we're seeing around the world right now. As governments meddle with their economy, there's only a few tools they can actually touch. Interest rates is one of those things they can mess with, and the value of the currency is one of the other things they can mess with. So they're constantly trying to tweak interest rates and currency values in order to find the right combination to preserve their economy. But in so doing, they're actually creating secondary and tertiary effects in the global marketplace that make foreign money either come in or foreign investment to leave the United States. So everything that we do internally ends up having a secondary and tertiary effect on what's happening in external international markets. That's how it is that you have Chinese people who own Miami penthouses when you don't have enough Americans to even find a home. It's because of this manipulation of currency values and interest rates. And sometimes the United States creates the perfect situation where foreigners want to buy American real estate and Americans can't afford American real estate. Other times it creates the situation where foreign countries want to dump their American dollars, and in dumping those American dollars, it significantly decreases the value of the American dollar for you and me. So when wealthy people diversify their assets, what it means is they take part of their US dollars and they put it into other currencies. They also take their US dollars and they put it into other government bonds. They also take their US dollars and they put it into physical, tangible real estate. Maybe that's commercial real estate or residential real estate. And they also take their real physical dollars and they put them into alternative assets like the stock market or cryptocurrency. By diversifying their physical dollars into these other asset classes, they protect against losing the value of the individual dollar. Because when you hold money as cash, when you actually keep it in your wallet, when you keep it in your bank account, every day that goes by, if the inflation continues to hold steady or increase, the actual value of your dollar gets less. So the $300,000 that you may have been working your whole life to save is actually worth less than $300,000 every day it stays in the bank. So if you were a very wealthy person that might have $5 million in the bank, they don't want to keep their dollars in a bank account because they know that those dollars are literally losing value every day. So they can put $1 million in real estate, $1 million in equities, $1 million in cryptocurrency, $1 million in foreign currency. They can diversify their dollars to protect their dollars. There are certain currencies right now that are doing very well. Currencies like the euro, currencies like the renminbi, currencies like the Swiss franc. These are currencies that are far more stable than the US dollar. So even if you didn't want to invest in a stock like Apple or Lowe's, you could always literally buy an investment in a foreign currency. You could buy euros and your euro would be stronger and more stable than your US dollar. If you think about it, this is how wealthy people think. If they put their US dollar into euros, for the next, say, 2 years, the US dollar decreases in value by 2%, but the euro stays stable. When they sell their euros in 2 years to gain US dollars, they actually get more US dollars than what they originally spent on the euro. That's how wealthy people think. They don't want to hold on to the cash they have because they know their cash is literally losing value every day. So they diversify. A second tool that wealthy people use is actually something called arbitrage, and they arbitrage basic loans. Arbitrage is anytime you buy something low and then sell it high. That's exactly what arbitrage is. So whenever you think about what you're supposed to do in the stock market or what you're supposed to do when you're buying collectibles, you're supposed to buy something at a low price and then sell it at a high price. That process is called arbitrage. The difference is that wealthy people have the ability to arbitrage basic loans. What I mean by that is they can approach a bank and ask for a $3 million loan. The bank wants to give them the loan because the bank knows that that wealthy person is very likely to pay the loan back. So the bank will do whatever it can to incentivize the person to take the loan. So while interest rates might say that the average personal loan costs 12 percentage points in interest, they will give that loan to a wealthy person for half that interest rate, 6%. Well, that wealthy person knows that if they can get a 6% interest rate on a $3 million loan, they can then take that $3 million and invest it in assets like cryptocurrency or like the stock market, and they'll get a 15 to 20% return on their investment. So what the wealthy person will do is negotiate with the bank to get a 6% interest rate that doesn't start until after 1 year. And then they'll take that $3 million, invest it in the stock market when they know the stock market is going to rise because they understand what's happening in an economic collapse. And then they'll make 12 to 20% interest over the course of a year on their $3 million. Then they'll cash out of the stock market and they'll pay back the original $3 million loan before the interest is due, which means that they've spent no interest and none of their own real money. Meanwhile, they have pocketed 15 to 20% of the value of the $3 million they already took, meaning they just earned about $600,000 for doing nothing. And that's how the rich get richer in a time of economic pressure, because everybody wants to lend to them and they understand how the economy works with economic pressures. You might be wondering, well, how would the rich person know that the stock market's going to increase in an economic collapse? And the answer there lies in the fact that wealthy people think differently about money. Because the wealthy understand that we are based on an inflationary economy, they understand that the stock market is one of the easiest things to manipulate using your currency and your interest rates, because businesses work just like people work. So as interest rates drop, not only do people take more loans, businesses take more loans. And as businesses take their loans, they invest in their business. And as business investment increases, so too does the stock market increase. And the value of each of those key stocks increases. So wealthy people can already predict that when interest rates go down, the stock market will go up. You probably already know that when interest rates go down, stock markets go up. But that doesn't mean that the stock market growth is permanent. It doesn't mean that the stock market growth is long-term. It doesn't even mean that that growth is healthy. It's just a manipulation of the economy. So wealthy people want to invest in the stock market early after interest rates go down because they know the value of those stocks will go up very quickly for a short period of time. And then they will turn and drop again. Just look at what happened during the dot-com bust. Just look at what happened during the Great Recession when the real estate bubble burst. You'll see exactly this same pattern, a rapid increase and then a drop. You can even look at what happened following COVID, a rapid increase and then a drop. This is what has been happening in economies going all the way back to the Ottoman Empire. When governments mess with the economy to try to please the people, and then the inflationary pressure ultimately collapses the economy in on the very same people they were trying to protect. Now you understand that wealthy people are actually growing their wealth in the middle of economic chaos. They're growing through diversification. They're growing through arbitrage. The third and final place that they're growing is with assets. Assets, meaning things that you buy with your money, have a very different behavior than cash itself, and they have a very different behavior than investment vehicles like stocks. Assets have the benefit of always having a limited supply. And because you have a limited supply of land, of water, of gold, the inflationary effect of the economy, meaning the increasing amount of dollars at decreased dollar values, has the inverse effect, the opposite effect on assets. So your house that you have right now will only go up in value as the economy suffers inflation. So the physical property that you have, which is a limited commodity, will only increase in value as the economy continues to collapse. Because the government and mortgage companies understand that as dollars are worth less per dollar, your property value can increase to be worth more dollars, but still actually carry the same core value. That might be a little bit hard to understand. As a dollar decreases from, say, a dollar value to a 90-cent value, meaning the dollar in your pocket yesterday was worth $1, the dollar in your pocket today is worth 90 cents. As that dollar value decreases, the value of your home, the value of your asset, the value of the gold in your closet actually stays the same. The value stays the same. But the dollar value, meaning how many dollars it takes to equal the same value, the dollar value goes up. So while gold might be worth whatever gold is worth, it takes more dollars in order to equal the same amount that gold is worth. Your house is worth whatever your house is worth, but it will take more dollars to equal what your house is worth. That accounts for about 50% of the price change you see in your house and the price of gold and the price of cryptocurrency. Simply put, the asset doesn't reduce in value. The asset stays stable, but the dollar value to buy the asset increases. Now, secondary to that, you have the perceived value of the asset. So not just the real value, but the perceived value. Because as every day goes by and your dollar continues to be worth less, the asset not only retains its value, but it's perceived to be even more valuable. Because while your 90-cent dollar might be okay today, tomorrow it might be a 75-cent dollar. The day after that, it might be a 70-cent dollar. 10 years from now, it might be a 10-cent dollar. Well, that makes that gold investment, that makes that cryptocurrency, that makes that home or that residential building very, very attractive. That's the perceived value. So not only do assets increase in value because of the dollar value that it takes to equal them, but they also increase in value because of the perceived value they have as a limited asset. There is no place that you have seen this more clearly than in cryptocurrency, specifically Bitcoin. Bitcoin is a cryptocurrency that has a limited number of total coins. And because it has that limited number, as the economy shifts and changes, the perceived value of Bitcoin shifts and changes. And as we have seen more and more uncertainty in the economy, you have seen more and more perceived value of Bitcoin on the open market. And that's not just specific to Bitcoin, that's multiple cryptocurrencies that you have seen in the marketplace. The bad news is that rich people will thrive in the upcoming economic collapse, and because of that success, they will further exacerbate the speed with which that economic collapse happens. And that's why you see people all over the world talking about the upcoming economic collapse. But the good news is there are things that you can do to protect yourself. If you own assets, if you own precious metals, if you own a home, then your assets are going to continue to offset the loss of the economic collapse. If you own your own business, if you have a way to turn your ideas into money, then you're going to be better set for the upcoming economic pressure pressure than anybody else because you can innovate and create new things that nobody else has created. The person who's going to lose the most, the person who's going to feel the most pain is the person who either has little money or no money, and the person who has all of their money basically tied in cash or tied to the stock market, because cash will continue to decline, and of course the stock market, after it rallies, will have a significant drop as well. There's not much you can do if you have no money. One of the key things that you can do is start acting now to buy assets. And if you have all of your money put into cash or put into some sort of stock market driven engine like a 401k or like a stock market savings account or some sort of money market, you can also move the type of asset that you're investing in so you're no longer tied to the stock market. In fact, one of the best solutions that I found out there is provided by something called Blocktrust IRA. Blocktrust IRA is a government-approved solution that lets you move your retirement savings out of the stock market, out of cash, and into an AI-controlled network of cryptocurrency investments. Better than Bitcoin itself, Blocktrust IRA has actually outperformed Bitcoin and the rest of the crypto market by 250% consistently since 2022. They have an incredible track record and a fantastic rating, not only among their cryptocurrency peers, but against standard banking peers for being able to protect and increase the investment benefits to the people who have an account with Blocktrust IRA. I myself have diversified my accounts, not only into cryptocurrency, but also into physical assets and foreign currency. I have arranged with Blocktrust IRA to give $2,500 in bonus funding to anybody who watches this video and then signs up for an account with them. So they understand the value of their asset, and they understand that in the coming economic collapse, there will be the people who hold their cash, believe in the stock market, and there will be people who diversify out of the stock market and out of cash, and they want to support that group of people. To be clear, cryptocurrency is not just Bitcoin, and I'm not a fan of Bitcoin myself for many, many different reasons, but I am a fan of cryptocurrency, particularly as an alternative asset to cash, because cryptocurrencies are limited in ways that cash aren't, and because cryptocurrencies will withstand the pressure of economic collapse in a way that cash won't. So if you've been looking for a way to protect the savings that you have, the money that you have, the legacy and the wealth that you have, and you know that cash is not going to be the solution for the future, you've been looking for what that solution is. That solution is diversification and modeling your financial behaviors off of the financial behaviors of high net worth and ultra high net worth individuals. They are already moving massive amounts of money into crypto assets because they understand those assets will survive the upcoming economic collapse. You can do the same thing using Blocktrust IRA. All you have to do is click on the first link in the description below or visit edscrypto.com and sign up today for your Blocktrust IRA account. Whether you choose to move part of your money, none of your money, or all of your money into it, you will find that that asset grows and is protected better than anything in your bank account, anything in your wallet, and anything in the international stock market. I'll see you there at Blocktrust IRA. I'll see you on the other side of all this economic bad news, where your wealth and mine have been protected by assets like Blocktrust IRA, and we will celebrate the fact that we moved when we moved rather than letting ourselves get crushed like so many people around us. I'll see you on the other side.